Happy New Year, happy 2024. Today we're going to be zooming into Wealthfront's latest innovation, the launch of 9 transformative ETFs. So I want you to sit back, relax, grab some coffee. Don't forget to subscribe if you find this interesting. Always interested in gaining new subscribers and new comments. Okay. First thing we're going to look at is, of these 9, which ones are which ones belong in what sector, which ones should you be paying attention to. I'm going to walk you through all that. So we're going to go through sector, we're going to go through returns, we're going to go through dividend yield, we're going to go through expense ratios, and these may or may not be something that you're interested in. It's okay if you're not, but if you are, continue to stick around. So the 9 that we're going to be looking at are actually on the left side of your screen here. We have a comparative 10-year performance of these. So things like URA, Devo, JEPI, or JEPQ, RYLD. So we're gonna, like I said, we're gonna go through each one of these. But before I do, I thought it'd be interesting to create a graph that'll go through the cumulative 10-year performance of these various ETFs. So some of these outperform others. So the QTEC right here, this is a collaboration of the tech stocks, the top 100. But this is a bond. This is a bond ETF. We also have things like Devo, which I invest in, as well as JEPQ. Sorry. So a lot of these have different use cases. There's different types of investors that would be interested in this. So let's start right now, and we'll get into the first one. So the first one we're going to look at is Devo. Now we're going to actually pull this up over here. We're going to look at the Devo ETF. We're going to look at right inside of Wealthfront. So you got 2 different charts here. We've got the cumulative return over here of the last 10 years, which is 111%, which is amazing. Although Devo's only been in the market since 2016. So we don't quite have 10 years left, or 10 years to go off of. But who's this targeted for? As we can see, it's an actively managed fund. It generates income by doing 2 things: investing in dividend growth stocks, and provides economic exposure through the stock market, while also selling written sold calls. So let's look at this right here. So written sold call options. What does that mean? You've seen some of my other videos, and I've talked about JEPI before. JEPI is another one that sells covered call options in order to generate income. So it takes the underlying asset and it sells call options on those. And if those call options are not looked at or not taken upon, then you collect the premium underneath, and that pads to your returns. The risk rating on this is average. The expense ratio is 55 basis points, so a little bit more than half of 1%. The yield is fairly good. I don't have a P&E on this chart, but the net assets are right around $3 billion. If you're an investor into big dividends, if you want a dividend ETF to look at, this could be one for you. Okay, next, First Trust Capital Strength. Let's check that one out as well. So we've got FTCS. First Trust Capital Strength, which I'd really not heard of until I started making this video. It tracks the performance of the NASDAQ Capital Strength Index. So for those of you who don't know what that is, the Capital Strength Index is it's an index much like you'd find with an S&P 500 or the NASDAQ or the Dow. It tracks stocks of companies deemed to be well capitalized with strong market positions with potential to their shareholders for a degree of performance over time. You'll notice this too, the risk rating is a little bit higher, mostly because we have companies down here that may be a little more risky. So in this case, we have top 10 holdings make up 21.86 of the fund. If I scroll down here, on the right side, I can actually see some of these are tech, like NetApp. We've got Costco, which is a behemoth. We've got a fairly good dividend yield, although not as good as Devo. And this is for someone who is looking for a little more diversification, a decent dividend, and a fairly mid to high expense ratio. This is something that's going to be a little more persistent and have a longer track record. If I look over here, the track record of this goes all the way back 10 years, even further. It's up 173%. So if you want more of a track record than Devo, this could be it. Okay, next one's probably one of my favorites, JEPQ. I've talked about JEPI before, but JEPQ is also a JP Morgan Premium Income ETF. Let's look at it here. One of the first things to notice is the insanely high dividend yield. So over 10% for 35 basis points and a high risk rating. Well, what's going on? JEPQ, much like Devo, is an actively managed fund, so it's not passive. It generates income by investing in US stocks like we've talked about over the NASDAQ 100 with low volatility, undervalued, and through investments in equity-linked notes that provide economic exposure through, again, we're seeing it right here, sell options, through sold call options. So again, we're selling call options of the underlying equities such as Microsoft, Apple, Alphabet, Amazon, all the underlying equities in this ETF. And we hope to capitalize on that by selling those and collecting the premiums underneath, along with appreciation on capital from the stocks such as Microsoft, Apple. One thing to be careful of is if you don't like a lot of exposure into tech, this top 10 holdings make up 43%. So if you want more diversification, this may not be it for you. If you want a longer track record, this only goes back to, I believe it was incepted in 2022. So we don't even have 2 years. So if you need a longer track record, JEPQ might not be for you. If you like more risk, you like a healthy dividend, and you're okay with an actively managed fund, this could be for you. All right, the next one, QTEC. Let's check that out over here on the big board. All right, QTEC seeks to, we're gonna do another underline here, seeks to capitalize or seeks to track the performance of the NASDAQ 100 Tech Sector Index, which contains stocks from the NASDAQ 100 Index. So I'm gonna go back over here, QTEC, we saw this just a minute ago, 410% over the last 10 years. If I move over here, we'll see the same thing, 410% over the last 10 years. So back in the COVID days, it actually took a plummet. This was right when COVID hit right here. It went down and it's just been on a tear ever since. Obviously, some of the same names you're gonna see again, Meta, Intel, Micron, Microsoft, Workday, Splunk. This one, top 10, makes up 25%. So a little bit less than what JEPQ is doing. So I would say better diversification, a little bit higher of an expense ratio, and the dividend is nowhere to be found. So if you want a dividend income producing ETF, this is not for you. Stay away from this. There is no dividend. However, if we go back to my original chart, QTEC compared to JEPQ, compared to Devo, has outperformed them over the last 10 years. And again, I know there's gonna be comments saying, well, Ryan, we don't have 10 years of data on JEPQ or Devo. I understand that. If you're long and you wanna go long in tech stocks, QTEC is for you. So mark this one down, put a post-it note on it, do what you gotta do. And while you're doing that, make sure you hit the subscribe button, hit the like button, drop me a comment down below if you like these types of videos. I need to know what works. I've been putting out a lot of content on my channel, a lot of surveys. I need to know what you guys wanna see, and I can tailor that especially for you. All right, moving right along, we'll go into RYLD. So RYLD was another one I hadn't really heard of until I started looking into this video and creating the content for it. RYLD is an ETF, a covered call ETF. So much like JEPQ and much like Devo, it seeks to track the performance of the CBOE Russell 2000 Buy Right Index with the Performance 200 underneath it, plus the income from sold call options on the index. So again, we're just selling call options, collecting the premium. If we have to sell out of some of the assets, we can. We still collect the premium no matter what, although we may be forced to sell the underlying equity. If you look here, the risk rating is high, mostly because you have, when you're selling call options like this, the risk does go up because you may have to sell out, or the call options, the premium underneath could be very high. The expense ratio is 60 basis points. The dividend yield is the best one we've seen so far. Let's go back to the chart here and see what RYLD, actually, let's move over here first, see what RYLD's done. So it's only been inception for not even 5 years. So it was incepted on April 22nd. So we're coming up on 5 years, which is not that long of a time span. It did take a pretty big drop here back in March 2020. That was when COVID. Since COVID, it's been up. Although over the last, let's say 5 years, 3 years, it's up 4%. So a little over 4%. So kind of too early to tell what's going on with this one. You may want to hold this one back. If you like covered call strategy options and you're a big fan of the Russell 2000, this could work for you. I will say that there's top 10 of their top 10 holdings. It makes up 25% 5% of the fund, and a big chunk of it's right here in VTWO. It does own other underlying equities like Super Microcomputer, Simpson Manufacturing. You know, I'm not really sold on RYLD yet, but time will tell. All right, moving right along, we're gonna go into SGov. So we're gonna rotate out of equities. We're gonna go straight into bonds. So let's check out what SGov has been doing. All right, SGov over here, we talked about, we've got some in here that are underlying equities, that pursue underlying equities, some with call options, some without. This is actually gonna be an ETF that tracks a bond ETF that tracks the 0 to 3 month treasury notes of the United States. So it's, like I said, it seeks to track the 0 to 3 month US Treasury Index, which contains US Treasury securities with remaining maturity of less than 3 months. So basically any bond that's going to expire within the next 3 months. The risk rating is very low because we've got it backed by the US government. The expense ratio, you're still paying some, although it's very low compared to the others, but you're also not getting the upside. You do get a fairly decent dividend with this, and all you're seeing down here is just different treasury bills. If I go back over, we're going to actually look and see SGov down here. I think it's the worst performing. Yeah, it is right here. This is the worst performing. This is the worst performing ETF in this group. Not to say that it's, you know, a bad performance overall. If you want very little risk and very little upside, where you're going to grow your money at maybe prime or prime plus one, depending on what inflation is, SGov is definitely for you. Okay, next one, URA. Let's check out what URA is doing over here. All right, let's check it out. URA, Global X Uranium ETF. I thought this was very, very interesting. I have not seen a uranium ETF before. If you have, comment down below and let me know. I've never seen one. I thought it was interesting. That's why I looked at it. Wealthfront seems to think so as well. URA tracks the performance of the Solo Active Global Uranium and Nuclear Components Index, and there's global companies involved in uranium mining and production. So think cars, cell phones, TVs, anything with a battery. EVs are all the rage now, so more uranium and more copper and more minerals are going to be going in there. If we look over here at who's actually invested in this, we see that top 10 make up 73% of the fund. So one company, Chemico Corp, makes up 23%. So who's this for? This is for someone who likes to take a lot of risk. As we see, the risk rating according to Wealthfront is very high. The expense ratio, I think, is the highest one at 69 basis points. The yield, the dividend yield is pretty good at 6%. A little over 2 billion under assets, but just be very careful with 10 holdings making up 73%. You better hope and pray that these two underlying equities here, these two stocks, Chemicor and Sprott Physical Uranium Trust, do not have a bad day, because that accounts for almost 36% of the fund is in two equities. So if you like diversification, I would stay away from this. All right, second to last one, we're going to go over USRF, Wisdom Tree Floating Rate Treasury. Yeah, this is more treasuries again. So we're looking at what, if you're interested in treasury notes, it tracks the performance of, let me get my highlighter here. It tracks the performance of the Bloomberg US Treasury Floating Rate Index, which just contains treasury securities whose interest payments adjust to reflect in interest changes. Their payments reflect the interest changes. So as the Fed updates interest rates to go up or down, or even it goes sideways, that's a whole other topic, you'll see the Wisdom Tree Floating Rate Treasury Fund start to move. Again, very low, just like you would see with SGov, because it's treasuries backed by the US. We've got a 5% yield, and we see there's actually only 4 that make this up. Treasury notes that make these up, all with different expiration dates. You'll see 10/31, 7/31. So this is for a longer track time than what you would see with SGov. So who's this for? This is for someone that wants very low risk, that wants a decent rate of return. But again, if I go back to my chart, my bigger chart over here, what has USFR done? Let's see, yeah, 13.49% of the last 10 years. So, you know, again, if I look over here, you know, not terrible, 13.49% over the last 10 years. So, you know, safe, effective, gets the job done, but also nothing to really write home about. Okay, the last one, XYLD. XYLD is another covered call ETF. It's almost like these things are becoming extremely popular. Might want to think about that. Leave that for the next. I've got another video coming out about covered call ETFs and why they're becoming so popular. So make sure to stick around. The last one is the the Global X S&P 500 Covered Call ETF. So this seeks to track the performance of the CBOE 500 Buy Right Index, which measures the performance of the S&P 500 from sold call options on the index. We've talked about that and 3 or 4 others. And what that's doing, I won't go through that. A 10.55% dividend, an average risk rating. So usually these are very high, so hold on to that. A decent expense ratio at 60 basis points, a little over almost 3 billion in net assets. But here's what I like. This may be my favorite ETF from this list. So the expense ratio is about what some of the others are. The risk rating is lower than what JEPQ or Devo is. The dividend is about where it is, but I really love the names of the top 10. So of the top 10 here, it makes up 30%, which I'm okay with. I really am, because we've got companies like Microsoft, Apple, Amazon, Nvidia. These are all companies, especially Microsoft, that keep increasing their dividends. Their dividend, the dividend percent goes up. They're reinvesting dividends back into the company, and their dividend, the amount keeps going up. So percentage-wise, dividend purchase price, all that continues to go up. Apple, good dividend. Nvidia, and I think Nvidia and Amazon are just amazing companies. The Alphabet, Meta, and then we've got Berkshire. So with just these alone, I'm okay with it making up 30% of my portfolio. All right. So last chart I'm going to go over is a different one I came up with here. This one just shows a 10-year performance of all the different ETFs. So like I said, my favorite one of this group is probably XYLD. It's only been out there for, I think it was inception. Yeah, it's been, what is that? Almost a little over 5 years, and it's up 42%. So I'm okay with that. I really am. I'm really okay with that. Now, I want you to comment down below which one of these 9 that I went over are you investing in? Which one do you like the best and why? Leave a comment, hit the like button. Don't forget to subscribe. And as always, don't forget to design your financial freedom. Take care. Bye-bye.